everybody, and welcome to a new episode of Startuprad.io, your podcast show with startup news and interviews from Germany.
Hello and welcome everybody to another interview at Startuprad.io, your number one podcast source for news, interviews, and events from the German startup world. Today would not come as a surprise to you that I have another guest here. Hello, would you like to tell our listeners who you are and what you do?
Sure, happy to. My name is Tamaz Giorgadze. I'm the CEO and one of the founders of Raisin. Raisin is a Europe-wide marketplace for deposits and savings. I myself am a Georgian national, live in Germany since 1995, and am married, have one small kid, and happy to be here today with you.
That is great. To just get a little bit in the story before Raisin, can you tell us a little bit what you did actually before? I may tell the listeners that you're not in your 20s anymore.
So I'm full disclosure, I'm 39, so turning 40 next year. In my professional career before, I was a consultant and served a lot of banking clients, especially a bit of insurance and government agencies at McKinsey Company. Stayed there for almost 10 years. The last 3 years, I was a principal in Berlin office.
And you joined McKinsey straight out from university?
Yes, that's true. So my university time was quite long. So I studied at the beginning macroeconomics, international economics, made my PhD in agricultural economics and quantitative macro studies, and then studied also law, so that I've joined right after my law degree.
Oh, so I got to be careful what I'm saying when you're a lawyer. Just out of curiosity, what made you leave McKinsey? Why did you actually decide to just hop off, if I'm so free to say?
I was 34 back then when the decision was taken. And for me, the question was, do I want to stay on the same track for the next 10 years? So to become a senior partner inside McKinsey to continue advising my clients, or do I want a change? And back then I was, first of all, not married, still able and willing to take a high risk, so that the decision then went clearly for more excitement, more volatility, more risk, because in my own perception, that was the perfect timing for an exit and for taking this additional risk. I think at a later age, so around my age at 40, people get more settled, families there, so the risk-taking appetite recedes. And back then, I was really open for new challenges, new opportunities. And also the last thing is McKinsey is a great learning place. But as everywhere, after 3 to 5 years, the learning curve flattens. And although it's exciting, international, and functionally very diverse, but one of the things I find particularly interesting is to also see own development continuing.
I gotta admit, many consultancies are a good place to actually do a lot of learning and learn a lot of useful tools. And I would be very curious how you actually settled for the business model, for the business area of Raisin, because I just imagine you have been tilted a little bit towards finance, so fintech would be the most probable. But why Raisin? What did you see? Did you have some magic insights? Did you use some analytic tools? How did you approach that?
So back then at McKinsey, since 2007, I was actually responsible on the functional side for the knowledge and client development, specifically for deposit and investment products for the EMEA region, meaning that both knowledge development, but also new client development was something I was doing inside McKinsey. What happened back then was, first of all, what I could see also from my clients, which sometimes were banks, regional banks covering several countries, that the savings and deposit rates and markets were very, very different country by country. The second thing is around 2008, of course, the global financial crisis happened and liquidity in the interbank market and the wholesale market dried up. So a lot of banks rushed into getting quickly client liquidity and access to retail deposits. And the last thing is with the continued volatility and with the intervention of central banks, of course, the client rates went down so that the area became very interesting as on the client side, record low interest rates lead to the fact that alternative offers became relevant and interesting. And on the bank side, this became a focus area in terms of creating additional channels and diversification on the refinancing of the bank side. So couple of observations from inside McKinsey, but not only, led to the particular interest for the deposit area.
Talking about that, we may add for the benefits of our listeners who are not finance geeks that actually banks have to take on a lot of money. They don't own all the money they're lending out by credit, so they have to take it in from somewhere. And actually, the money you have on a savings account, on a current account, that is actually all money the bank on the other side at least partially lends out in credit. And so therefore, usually the difference between the interest rate they are paying you and the interest rate they're getting is how they make their money in a traditional business way. And so if the banks are in need for more money because they not only have this retail savings, but also wholesale financing, talking about issuing bonds and stuff like this. So if this, as you said, dries up, meaning there's less and less demand for the bonds you're selling, and actually usually you're not selling bonds because surprise, I need a few hundred millions, but actually you have bonds that you need to pay off, and therefore you have to issue new bonds. So when the banks started to see there is less and less demand for my bonds, they have to turn on another way in order to avoid not being able to fulfill promises to bondholders. Is that right?
So that's right on a high level. I think the regulators also recognized that on the refinancing side, banks were running to structural deficits before the crisis. And many of the insolvency cases or bail-ins were actually driven by those factors. First was that liquidity duration on the taking side, so on the liability side and on the asset side, were mismatched. And that was widely mismatched, so that banks were refinancing very, very short and lending very, very long, so that they were taking an interest rate risk for a long time. And that led to introduction of specific ratios and criteria like liquidity coverage ratio, which leads to a better matching of the different durations on the bank book, on the bank balance sheet. The other thing which regulators also noticed while analyzing the crisis is that wholesale money is quick in reaction and quick to dry up, so that they introduced both the coefficients and also the minimum requirements for net stable funding ratio, meaning for the funding quality, and the funding of the bank is then structured in a way that different buckets of funding from purely wholesale or interbank and then towards the client funding are weighed in a different way, so that the client and retail funding gets quite high and good coefficient, and long-term deposits are valued higher than short-term wholesale or interbank funding. So that led to the fact that there was also particular demand after the crisis, after the client long-term stable funding.
Without getting into too much details, I would just add that the net stable funding ratio, NSFR, and the liquidity coverage ratio, also called LCR, are just a few of the numbers the banks have to submit on more regular basis to the overseers like BaFin, European Central Bank, and who else is out there. And so it makes a big headache for those banks to actually deliver this data. But on the other hand, it also makes the retail investor a more promising target because actually, as you said, it sticks longer. That means if you have a savings account, you put the money in and maybe in a year or two, you're planning to take a vacation on it. So that means the money sticks with the bank all the time and you're not actually opening an account, closing an account, opening an account, closing an account, but rather you have an account and then you have on a stable basis a certain amount of money on it. And that is what the banks are counting on. That is where they get their money to work on. And that led you to your idea, right?
That's correct. So that was, we run a marketplace. So we need demand on both sides. So that was the structural driver and justification for the demand on the bank side. So why there are banks out there willing to join our platform? And then, of course, there is the other side of the marketplace, which is end clients. And there the market is huge. So in Europe in total, we have around 10 trillion euro in savings of private households. And the money is right now at a record low interest rate. So that quite naturally people are looking for better savings deals and better savings options out there. Plus, quite naturally, this area is also one affected by the move towards digital channels, so that people are increasingly looking for offers online.
What I would be curious about, because I tried to tickle out a little bit of your personality, how did the first people react when you told them, okay, I'm dropping my job as a consultant, which is usually paid pretty well, and I am going to open a company that does actually broker retail savings. How did the people react?
It was a mixed reaction, mixed being roughly, I think, half of the people whom I told that what I was planning of doing asked whether they can invest into the company. So the seed investing was quite easy in that sense. And half of them thought that I was really not thinking anymore. So they couldn't really realize why I was doing that and why as a McKinsey partner. I think one of the VCs, which we met at the very beginning and turned out to be one of our co-investors, really asked a couple of times whether I'm really a McKinsey partner and why would I be doing this as a McKinsey partner, switching gears and going to a startup company. So that there was to put it positively, a mixed but positive reaction.
I can't avoid a smile when I hear this. And how did you actually start out with Raisin? What were your first steps and how did it actually develop till today? Were there several milestones you actually reached? Because I've seen in Crunchbase you have raised a series A, B, and C already. So can you tell our listeners who are out there and thinking of starting a startup, tell about getting to this point where you can actually raise repeatedly VC money? How was the way for you?
So I think it's specific and challenging to create a marketplace because you need to punch above your weight on both sides, especially on the provider side. So what we've seen at the beginning is that a lot of banks we talk to like the concept, but no one really wants to be the first or the second one joining. Why so? Because people perceive it as an unproven concept. So this was a first of its kind, so that there were a lot of questions around compliance, anti-money laundering, legal setup, client identification, KYC, and client due diligence rules, so that it was an uncharted territory. And even if you can answer all the questions and have legal opinions, still being a first one joining a business model feels like a bit riskier than being a number 10 or 20th joining the same business model, which is then proven and has had its child diseases. So that was hard and challenging. The second thing which was challenging is that to build up a product which is at the beginning as simple as possible, so that we stripped out almost all complexity out of it, but to make it more progressed and mature over time. So that as you could imagine, we started actually with just one bank and one offer, and we had the one bank and the one offer stalemate for quite some time, for 4 months in total, where the bank actually started to ask and question us almost every week when is the number 2 joining and whether they can talk to the number 2 and number 3. And the challenge stayed over the first 12 to 18 months to generate enough B2B demand, so to have the bank partners joining. By now, we've progressed a lot, so we have already 34 banks live on the platform from 17 different countries, and are adding quite a few new partners, meaning that on that dimension we're very good. We can take any type of operation setup. We can ask all legal questions. We can cover almost 30 countries from the regulatory side, so that we are advanced, knowledgeable, and a reliable partner on this one. And I think, the most professional company in the market offering such type of retail access to banks. So that was a long journey, but the journey was worth it. The second one was building out the platform itself and the product. And there we started with a simple product, which is a term deposit. And we started with long durations. Now, 3.5 years down the road, we have overnight deposits. We have notice accounts. We have fixed deposits. We have term deposits with short durations. We have flexible deposits which can terminate any time. So we have a lot of different product variations. And all of those we developed, of course, over time, but we try to satisfy both the client and the bank demand to a maximum possible level. And also we are introducing constantly new products. We will be going outside of savings and deposits quite soon, so that we, for the clients, we enlarge the areas of investment or areas of possible investment beyond pure play bank deposits. So that's in a very short nutshell the journey. The raising the funds always remains challenging, of course. I think it's less challenging at the beginning because people just believe your vision. And people believe the quality of the team, but then later on they just do not only trust on their gut feeling and the beliefs, but they want to see hard numbers. They want to see customer acquisition costs. They want to see how fast you are getting revenues. They want to see the growth trajectory, scalability of the channels. So many more hard facts belong to the round B, and even more of those to round C, so that raising funds never is too simple. At the same time, I think there is a saying, it's always worth raising when you can raise. So we tried also to raise even before the due time.
That is pretty interesting. Can you give us a few more hints in what kind of products you're going after savings?
So in general, we will be staying on the client assets, meaning on client savings. Of course, deposits are roughly in continental Europe half of private wealth, but quite definitely clients need also other types of investments, so that we will be, of course, offering access to equity and bond markets through digital products, which are low cost and are very good value for money. We will not be doing this product standalone. We will be partnering with other large, more experienced companies. The idea behind the platform or behind the marketplace is to offer the client digital access to investment products at a very low cost in a very convenient way, so that this vision which we had from the beginning on, we are slowly putting in place so that one of the next products will be a low-cost exposure to passive investing, and then many more will be.
We might add for our listeners that we conducted this interview towards end of August. So since we are trying to publish only one Startup Radio interview or news a week or every other week, this may take some time till it becomes actual reality. Few more questions towards Raisin. Are you actually a bank? Are you regulated?
We are ourselves we have different dimensions of our activity. And our activity is regulated differently country by country. So one of our core activities is deposit brokerage, as you rightfully said. That activity doesn't need a license in Germany, which is our core market, and is treated differently in different countries in the European Union. So, for example, in France, there's a financial intermediation license, and in other countries, we are either getting a license or we have a clearing from the regulator, from the central bank, that we do not need the license in the setup in which we're operating. So that part of the activity is we're taking care of, and there we follow the local licensing rules. A bit unfortunate, though, because it's very hard to build in this way a pan-European business if you have to follow licensing rules country by country, and there is no comparable fintech license or any other financial intermediation license which would be passportable across the European Union. So that is one of the things I think which would enhance the common market and the single market very much in the future. The second level of it, or the second dimension, is the activity we're providing towards the clients and towards the banks. And there we have some part of the activities which necessitate either a payment license or a bank license. And in this regard, we're acting as an outsourcing provider towards the bank, so that we give this license in the name and on the behalf of one of our so-called servicing banks, which are white label banks providing together with us the services towards the clients. So that the whole package is, for customer, it's a homogeneous package. So he's becoming a Raisin.com or a Weltsparen.de customer, which are our two brands. In the background, there is, of course, a lot of complexity which we are managing, including the licensing and regulatory part of it, on which we are either ourselves fully licensed or rely as an outsourcing provider on the license of a financial institution.
And I do assume your client has only to go once through this KYC process, meaning has to put in all the passport data and stuff to make sure they are an actual existing person and that they are the person they claim to be. Is this true? And how do you transfer this data to the banks? Is there some kind of agreement there?
Yes, that is true. The principle of the marketplace is a one-stop shop principle, so that the client has to identify himself once, and he gets also just one technical access to an online banking platform where he can administer, open, close different accounts of different banks, so that the core of the solution and of the value add is exactly the integration of various offers and various providers into one marketplace, and also maximum leverage of one KYC process at the beginning. Now, how do we operate it with the outside partners? There we have different setups, meaning from full KYC reliance towards additional criteria asked by banks. Customer in general selects all the products and providers individually, and in this process he also authorizes our servicing bank and asks to forward data for identification reasons to the product provider, so to our local or foreign partner bank receiving deposits. That's it. We are, of course, following strict rules both on data protection, and we are regularly auditing our high standards, meaning we have an annual audit by TÜV, and we have also audits on many other areas, including our internal control systems, penetration testing. So whatever you would expect from a very mature financial organization, we put it in place and are as strict there as any banking provider is.
And do you yourself actually transfer this client money, or are the banks doing it on behalf of you?
So indeed, it all goes through banking infrastructure, meaning that we do not touch the client funds at all. So they never land at our company account or at fiduciary accounts. So they always go through client accounts, and the payment is executed either through SEPA in the euro area mostly, or through Target 2 or any other payment trails existing there. Also in the cross-currency setting, we go through correspondent banks. So in that sense, we're using the banking infrastructure for the payments area. At the same time, client funds are always on individual accounts, fully protected by the Deposit Insurance Agency, so that client also has anytime access on those, plus anytime the guarantee fund is they're subject to the guarantee fund protection.
Guarantee fund protection means what? How is the money actually secured?
So we have in Europe a harmonized scheme of deposit insurance guarantees, which means that there are minimum standards which have to be fulfilled by any member country and also by the countries of the European Economic Area. It means that for every individual client, 100,000 euro in equivalent in the local currency is subject to the protection of the deposit guarantee fund of that particular member country.
Getting a little bit less technical and less finance geek. Took from the interview that there are actually trillions out there in potential client money, and you just passed the threshold of 4 billion euros that you actually brokered as savings towards your partner banks. Congratulations to that, but seeing that there are trillions out there, aren't the 4 billions just a drop in the ocean?
There are indeed. So we also believe that we are right at the beginning of the journey. So the market is very large, and for us to make also a difference both on the client side and also on the bank side, our objectives are much higher. Also, our ambition level is much higher than that. So that I fully agree with you. So 4 billion is a good starting point, but it's really a starting point in a very large market.
I would be a little bit curious about your customers. So who are the people that actually invest the money with you or brokered via you? So it would be a little bit interesting for me, since you can see on your website the cooperating banks and the interest rates and all this stuff, but nothing about the other side of the people. Who are the people that are entrusting you to broker this money?
So indeed, we of course educate about our banks, but educate less about our customers. We're subject also, as mentioned, to data protection rules, and we can give some glimpse on our typical customer profile. It coincides very well with the different savings life stages and asset development of a typical banking customer, so that our customers are a bit older and better educated than an average person, because those are the people, of course, who have higher savings, and then where our value proposition actually hits their demand or their dormant demand. Our average customer is above 50. They are mostly male, so our share of female customers is increasing, but it's still more than 50% are male customers, and the customers are slightly better educated than the average. Okay, so 10% of customers, so slightly below that number, has a PhD degree. So that's a fun fact about the education background of our affluent client base, which has high level of savings, which are typically male and of course older than millennials, because those customers have then already amassed savings.
How high are your actual customer acquisition costs? How do you target those people, and how much does it cost you to get them on board?
So we use quite different channels. We list our products or products of our partners on affiliate channels. Compare, of course, have any type of online advertising from we're using Google AdWords, campaigns with outside partner online. We are also offering the product through outside providers, also financial institutions. So, for example, you might have noticed that N26, one of the more prominent fintechs from Germany, offers N26 Savings, which is an offer powered by Raisin, so that we integrate our offers also into outside partners, financial institutions, banks. We run TV campaigns in our core market, Germany, and rolling that out also broader in Europe. We run out-of-home campaigns, so it's a very wide mixture of different channels we're using.
And I did understand you kept quiet about the customer acquisition costs.
That's a very accurate observation.
So, coming towards the end of our interview, and may just both for the reason that right now the internet appears to be very busy and our connection is getting worse, what are actually the incentive for the banks? Are they actually in need of those retail deposits? Do they really want it? Is there like a demand from the bank side? We want to have more and more retail money, because I could assume if they are coming through your channel, they would be a little bit more likely to hop around between the banks that you have as partners, because that would be more easy for them to arbitrage the interest rates.
So we indeed see an increasing demand because it has to do with a simple fact that we have more and more banks live on the platform. I think the volumes, of course, the platform grows very much in parallel. We've more than doubled our size this year already, so that we are able also to satisfy the demand of our partners, both in terms of the volume of inflows, but also in terms of the stickiness of the funds. In why are they joining our platform? Those are many reasons, different reasons. Reason is diversification, because we're giving access to the largest European markets, direct platform access. So for them, it's a separate channel. It's a very easy to use and integrate channel, fully flexible. So that it's like software as a service. So they pay only as they use. There is no setup fee or minimum fee. So in that sense, it's quite a convenient, fast to use diversification. It's very simple on the other side. Different currencies. So, for example, we have a couple of banks from Sweden, Poland, from UK, which have on their balance euro assets. So they want to refinance in the same currency, and this is the service we're offering. We have also on the other side offers in US dollar, Norwegian krona, so that we give also our clients possibility to invest and deposit in the foreign currencies. So in that sense, the access to euro funds is a valuable criteria and value proposition for the banks outside of the Eurozone. Then we have banks which are fully wholesale funded until now, and for them having a, like in retail area, without a lot of effort and building retail infrastructure like own call centers, online banking software, and so on, is a valuable feature. And then we have also, of course, startup banks who want to build up the funds quickly, and that's our platform because it's quite large by now. So that there are different individual cases, different individual backgrounds. I think the common denominator is that the banks like our speed, flexibility, and quality of delivery, and no bank which has ever joined us has left the platform.
We know that a lot of investors are listening to our podcast. There have been numerous occasions when startups have been contacted by people listening to our interview who happen to be business angels or VCs. Are you currently looking for a Series D?
We have, for background, roughly 60 million euro And the last funding round, the Series C we've made, was just at the beginning of the year. So we're funding. We're not out on the market for the moment. I would say we are not actively looking for. On the other side, you should raise when opportunity to raise, so that we are not actively looking but passively listening.
Before I ask my last question, do you think we forgot something important, something you would like to talk about?
I think we covered almost all areas. I think one of the topics and one of the areas which we see as a trend and which we are really pushing through is creating for a core area for the client. This is the largest single product out there in the banking. We are creating a open access for the customers and a marketplace environment. I think if you think about it, it's of a really huge value, and it mirrors a bit what happened in the fund industry in the 80s and the 90s. Until then, all major players had their captive funds, which were offering only homemade products to their clients, so very protected environment. And out of the sudden, the whole fund architecture became much more open-ended and much more accessible through one channel. You could buy funds of any providers. Brokers came up, which were giving it at very low cost. So I think the same thing is happening on the savings and deposit side. Until now, some banks have privileged access, like with the fund world. There are incumbents which have huge branch networks and old savings books. Those banks are overfunded anywhere across Europe, and there are a lot of mid-sized players who are actually increasing the competition and also going for client deposits. And we are a market instrument to level out the level of funding across the banking industry and to give the clients the best product available and the best product which fits their needs. So I think this whole marketplace environment is very much in line with what happened in the banking industry before on the fund side, which happens also currently in parallel on the credit side with credit brokers and marketplaces like Interhyp, but also with banks opening up their infrastructure and offering. So I think same and obviously and hopefully successful as in the other areas with the savings and deposits.
I would, for example, like to mention Fintura here based in Frankfurt. And there would be the last question. If you would describe your life either as a book title, a movie title, or a combination of both, what would it be and why?
I would say my in the last have been like a nice and exciting roller coaster ride where you don't know which direction you're going, but why it feels this way is that I think every founder will and every entrepreneur, it's an exciting journey, and you go through all emotional phases and in 1 month you might feel yourself as being on the top of it and winning all deals, and just 1 week later it feels completely devastated. You want to confess to your wife, your parents and your child that the company is going bankrupt, and any feeling and shade of feelings between those are possible. So that's really also like about it. It's a lot of volatility and a lot of emotions in between, and that's also the fun of it.
Thank you very much. I'm very sorry for all the interruptions we had on both the sides. Unfortunately, the internet is outside of our control, so there's nothing we could do about that. Maybe I have to edit the interview to a point where some of the sentences of Tamaz are actually out, and that may be just for the reason that they have been so disturbed that you could not recognize it. Nonetheless, thank you very much for staying on. Thank you very much for the interview, and hope to hear from you again.
Thanks, Joern, and thanks to everyone.